Good afternoon, and thank you for joining us for today's webinar, Q3 Trends and a Look Ahead. My name is Sean O'Brien, President of QwickRate, and as always, I'm pleased to be joined by David Ruffin. David's the principal at our IntelliCredit division. And welcoming today, Dan Marks is going to join us. Dan's the president of Infusion, and Dan's and on the deposit side. So welcome, Dan and David. Thank you very much for joining us today. The agenda for today is, again, we'll discuss some signs of optimism that we see here in the quarterly numbers. We'll talk about the QCBI results. David will do his credit update. Dan will do a deposit and customer update. And then we'll just tell you again what's new here at QwickAnalytics IntelliCredit. As always, we'll start with a few polling questions. Appreciate your participation in these. Oops, let me see here. Here we go. The first one up is really where does loan generation fall in your marketing and sales priority for the coming year? So again, we booked account response rates above 3%, above 2%, booked account response rates above 1%, or response rates less than 1%. So we'll just give this a few seconds to get going.
Yeah, I think Sean, actually, this is the answers go with one of the other questions, but
oh shoot, okay,
it's fine.
Right.
First time.
There we go.
We'll
yeah,
adjust.
we're starting new. Okay, we'll just go ahead and end that one then. We won't even bother sharing the results then. Well, I wonder if this one's backwards then too.
No, that's right.
Yep. Okay, good. What is your household penetration of CDs over the past year? Up over 100 bips, up less than 100 bips, down less than 100 bips, or down more than 100 bips. So we'll give this one a few seconds to go. Okay, we'll go ahead and end this one. Go ahead and share those results. So 44% up 100, 39% up over 100, excuse me, up. First one was 44% up less than 100, 39% up over 100, and 17% down less 100. So thank you for participating on these. And just a reminder, we will send out a link to today's recording and a copy of the slides with the results from the polling questions as well. What specific impact are you seeing on deposit generating campaigns versus last year? Dan, this one look all right?
Yep, that's good.
Good. All right. Booked rates above 5%, booked rates above 3%, and booked rates above 1%. So again, we'll go ahead and just give this about 30 seconds or so to respond. Open that one and share those. So 52% above 3%, 30% above 1%, and 17% above 5%. So thank you for participating with that question. Stop that one. Let's move on to some CRE questions. Which CRE subset, other than office, do you consider the most challenging going forward? Just a single choice here amongst industrial warehouse, multifamily, owner-occupied, retail, 1 to 4 family rental, and hospitality. That one. So it looks like the leading answer was retail, followed by multifamily, and then hospitality and industrial warehouse. So thank you for answering on that one. I think we're almost to the end here. I think one final question is just on credit concerns. which credit type gives you the most concern in the near term? Again, a single choice, C&I, CRE, small business, or consumer. CRE, kind of the runaway winner here, CRE, followed by consumer, and then C&I. So again, thank you all for participating in the polling questions. We will make those available in an email to you, likely either late tomorrow afternoon or more likely on Monday. So thank you again. So again, just a couple of things that we've been following here quarterly, just on the level of uninsured deposits in the institutions. Not much has changed here since last quarter. We continue the slide though, just as a reminder. I think increasingly we are hearing, certainly in exams, regulators wanting to confirm that banks have the ability to cover or have the capacity to cover their uninsured balances as part of a liquidity or contingency funding plan. So we'll probably just keep these slides going just to remind you of these percentages that we're kind of seeing across the industry. The second level that we have kind of monitored for the last couple of years is the level of underwater securities. This actually improved at 9/30. We may have backed up here again over the last 15 or 30 days, but at least at 9/30, these looked decidedly better in the wake of the initial Fed cuts to interest rates. So again, hopefully, a problem that is waning, and also now on the flip side, will start to accrete some capital back into the institutions. I think the final, slide here before we get into some of the numbers is just, again, what we, kind of see just as a continued new normal for deposits where, we really are, always have been, in search and seeking new deposits. But, I feel like in most markets, your best customers are going to be continued to be, kind of, if you will, under attack, for people wanting their deposits. And so I think, it's strategies to make sure we're protecting, but also trying to, gain larger wallet share from our customers is something that should be top of mind. I think, certainly some signs of optimism with the cuts in rates that should improve margins. They also should help collateral values. And at some point, if the back end and the 10-year start to cooperate again, we might see some refinancings. I mean, obviously there's a low level of mortgages out there, but we might get some new activity there as well. An end to the inverted yield curve that we've been experiencing for a couple of years should be positive as well. And then, as we touched on earlier, the lower rates should help with some of the unrealized losses in our securities portfolios. And finally, I think as David will touch on, right, loan losses to this point still are low and manageable. Past dues are starting to rise, but at least at this point, loan losses have, still remained really manageable. As we look ahead, for the rest of the year and into next year, right, it looks like, we'll have some soft landing or no landing, that there will be continued pressure on deposits. And as I mentioned, while loan losses are low, delinquencies are starting to rise. And I just think probably for the next year, the regulatory focus on both, areas of our loan portfolio, but also our liquidity will probably continue to be, very, very present and slightly heightened, I think, from where we've been the last couple of years. As we look at the QCBI numbers, asset growth, you can see over the last 12 months has picked up a bit. We've seen, loan growth, again, better than the last 12 months when we were talking about this in June. So that's encouraging. Excuse me, it was slightly down from where we were in June, but still positive. So we'll see how that looks towards the end of the year. Deposit growth, was up, better than we had been even in June. So encouraging. Still, you'll notice 30% of the banks, of the community banks in the country, experienced no deposit growth here over the last 12 months. So certainly, there's still a large percentage of banks who are really struggling with deposits. and that's again evidenced by those 30% at 0 or less. Yield on loans is kind of a symmetrical increase both on the yield and cost of funds over the last 12 months. And again, I think for the banks that we saw perform better this year, higher yields on loans was clearly a correlating factor in that mix. But really across the board, banks have been able to pass on some pricing increases in pricing, so that's encouraging to see. But as you can see in the lower slide, cost of funds, still pretty strong and high across all of the asset buckets. NIM actually improved over the last 12 months, so that's encouraging to see. The 0 million banks, still kind of leading the way. But in terms of non-interest income, it's kind of flipped, where clearly the 1 to 10 billion banks, certainly have a decided advantage and some scale when it comes to non-interest income. Efficiency ratio continues to tick up, so that remains a challenge to earnings growth. Is that number has just again over the last 4 or 5 years just slowly but surely just kind of eked up, and again for the 0 to $100 million banks, approaching 74%. So again, something to monitor and continue to try to find ways to incorporate technology or just ways to try to find some efficiencies in our institutions. Profitability is kind of flat over the last 12 months from the previous 12 months, and core operating earnings the same kind of way, just a little bit slightly down, but relatively flat. ROA and ROE, kind of the same story, not surprisingly. And again, really kind of even across all asset size buckets. But again, the 0 to 100 million, only at 7% return on average on equity. Just a reminder, it's in the chat. So we introduced this page of the performance matrix, which again, one of the requests we had was to go beyond just the median values we show you in the QCBI. So this gives you a little bit more of a percentile spectrum. This is available at both the national and the state level. You can certainly request a free report from us. There's a link in the chat, so you can click on that if you'd like. But just to kind of a quick summary on this, right? Again, most things haven't really changed from the previous quarter. I think the one area where there's been some again degradation is non-performers have ticked slightly up. Reserves are still kind of relatively flat. Yield on loans, cost of funds, NIM are all higher. And again, as we touched on the efficiency ratio, you can kind of see the spectrum. The one area where, again, I think probably most notable is just, again, if you start to look at the non-performers at above the median, those numbers certainly up, from the previous quarter. And the capital ratios actually are better than we saw in June. At this point, I'm going to turn the presentation over to David, and he's going to walk you through the credit numbers from this quarter. David, I'll stop, and you should be able to take the screen.
All right. Hopefully you're seeing this.
It's coming. There we go. There we go. I can see it. Thank you.
There we go. Well, thank you so much, Sean and Dan. It's a delight to have you join us for this quarterly ritual. I always enjoy it. One of the things that we do on the credit piece of this is we glean information from 3 primary sources. One, our sister division, QwickAnalytics, on forming some kind of regional peer groups among states. We also get it from a very robust amount of loan review work we've done in the last few months, but also I have attended numerous and spoken at numerous conferences coast to coast, and heard, anecdotally from bankers and what their concerns are and opportunities are as well. So that's really what we'd like to kind of focus on. Perhaps a good segue away from a good bit of the funding talk is to kind of look at where wholesale funding is. It is beginning to plateau and trend downward. As Sean said, there's been deposit growth to allow some of the pressure off of that. Regionally, there is a rather good bit of bookend between the northeastern states, which has the highest level of funding wholesale wide, to the Southwest, which is down to 6.2% of their total deposit base. A corollary to that, of course, is what does that look like in loans to deposit? The same bookends apply here. You got the West at 90% on aggregate. Remember, these are QCBI numbers. They're assets banks of 10 billion and under. And then you've got the Southwest at on an aggregate average basis of 70% loan to deposit. We'd always look at this as really our kind of thumbnail of credit quality. As you can see, not much regional distinction in our what we call our inventory of credit problems, which is the non-performing loans to loans. But clearly, as you can see, since the year end of 2022, we've begun to slowly tick back up in terms of acknowledged weakness in our credit portfolios. Not significant, but certainly a trend that is undeniable. There's also been a little blip up in net charge-offs. In this particular case, the Southwest banks seem to have led that. And our more traditional approach of looking at where reserves are to loans, you do have some disparity between the western states that are up at 150 bips and the Northeast are down to 100. So that's a pretty wide spread among the regions in the United States in terms of where reserves are. And that has a story because, as you can see, again, we've got upward momentum in problems and upward momentum in charge-offs a bit, but a continuing to kind of decline gradually, again, at the smaller banks in terms of reserves. You've heard me refer to this as more the inverted way of looking at it in the past, and that's how much of your inventory is being covered. It's still significant in terms of percentage. Again, I hasten to say we don't have a significant inventory of problems at this point, but the coverage of our reserves, we're not talking, of course, about capital cushion, we're strictly talking about the allowance for credit losses, or the CECL, has declined. Why this is important in terms of a trend, it unfortunately still, I think, puts a bit of a larger target on smaller banks for regulatory scrutiny, because the larger banks have continued to increase actually their reserves against where the community banks have been. And this, which I thought was quite interesting in the polling, that CRE is clearly now emerged as, even the non-office CRE has emerged as a credit concern. It's certainly out there in terms of regulatory scrutiny, but large banks have continued to decline in their exposure to CRE, while community banks, I've said this for 2 or 3 years since the pandemic, have virtually buttressed their entire loan growth on CRE. As of third quarter, however, what we can say is that has leveled off and is really kind of flattened in terms of further growth. As far as the traditional concentrations that we get and look at, of course, is the 300, 100% guidance. We'll start on the right, which is the broader 300%. Again, you've got the Midwest, which is in yellow, is the least, and then you've got the western states that are showing the largest exposure to risk-based capital. The numbers are at the bottom of each chart. For example, 320 banks in the country exceed the 300% guidance. Again, remember, it's a guidance, it's not a regulation. And then the subset of that is the construction development loans to risk-based capital, which predictably usually tracks the Sun Belt in terms of areas or regions of the country where there is both migration of population and business opportunities. So that's not uncommon that you would have the Southwest and the Southeast lead in that particular category. As far as the other concentrations we look at, I did note in the polling that multifamily, sometimes I get in a little bit of trouble on the speaking circuit. That frankly is my biggest concern, particularly for smaller banks right now, because I think it's been my experience over my long credit career that when we start getting some stabilization back in wonderful family mortgage lending, is that pressure builds on multifamily. They kind of operate like a teeter-totter or seesaw. When one's up, the other's a bit down. There are other structural pressures going on with multifamily in terms of their ability to not be able to raise rents and their internal costs to operate units. And there is, in certain markets, arguably already some overbuilding going on in multifamily. So that is, in my point of view, the one subset asset class of CRE lending that warrants concern, or warrants more monitoring, I should say. We haven't seen significant problems in it at this point, but certainly in looking at the intermediate future. C&I, of course, has just returned to its norm since the non-organic PPP activity during the pandemic. Ag, of course, you would expect the Midwest to be significantly leading the other regions of the country in exposure to ag. So let's talk a little bit about what are some of these concerns that we're gleaning both from our loan review work and from conversations with bankers at conferences and so forth. And I know this is really the whole issue to me about why credit risk and vigilance around credit risk now is still quite critical to maintain, because so much of our mindset, so much of our financial press is kind of dominated by a Wall Street perspective of what has happened from quarter to quarter. In other words, the short-term rate market and what have you. But as has been said many times, banking is about funding short and lending long. Credit is a long process. It doesn't turn overnight, no matter what happens, including, frankly, election results that some people probably rightfully think is going to have some impact on regulatory issues. So I'm here to say not to be the naysayer here, but I think we particularly got to still keep our eye on the short to longer term aspects of the credit issues we're seeing. The servicing, again, continues to be somewhat spotty, and that's the post-booking, not the underwriting. It's never been any better. But the servicing of how banks are monitoring their credit portfolio performances is still not uniform across the country. There's no question now that rate and inflation shocks are taking tolls, particularly on certain subsets of consumer borrowers and small businesses. The one term that I heard, frankly, a couple of weeks ago at a conference on the West Coast was the term CRE segment obsolescence. And I think that we're going to be living with that for a long, long time. The reality is that, teleconferencing, digital shopping, working remotely have arguably changed the paradigm of much of what we think of as commercial real estate. And that is going to be a long-term play that I think bankers are going to have to factor in their credit quality prism assessments. And again, disproportionately, it puts more pressure on community bankers because we've taken so much more of our loan growth from that segment. There's certainly more risk grade downgrades, rather, that we've seen in our loan review work than at any time in the past decade. Of course, we've had an incredibly good run of good benign credit performance prior to the last few quarters. We're still seeing some heightened and very, very high profile scrutinies of particularly credit process assessments by the regulators. Some of the most of the orders that we're seeing, again, particularly is directed to CRE management within portfolios, or what is deemed to be deficient management. We've The other long-term play of credit is this whole issue, the repricing that we have to still experience. And there have been several estimates that go from $1 trillion to $1.5 trillion yet to be repriced before now and the end of next year. But again, I say this like a broken record, and I apologize, but it is what it is, and that is smaller bank loan growth has been largely CRE even since the pandemic, and virtually all other credit providers in the American economy have tried very hard to reduce their exposure to that. So I will say again, I think I shared this last quarter, but it may merit repeating again, and that is this is really more of a pattern of what we've seen to be embedded in regulatory orders for banks to improve their CRE portfolio management. Obviously, it's focused heavily on the subsets. That was why we asked the polling question. We did not talk about just general CRE. Those guidances of 300, 100 are really not very pertinent, in my opinion, right now. I think it's all about the subsets within those various guidances that is the burden on the banker to make sure that whatever concentration that has emerged out of those subsets is quite defendable in your relationship with your regulator. The other thing that has emerged clearly out of this, I think we talked about this a little more in detail last quarter, was this whole burden now of not just doing your credit underwriting in a traditional way, but also looking at the econometric and supply and demand aspect of whatever footprint you're lending into. That's now pretty much part of the regulatory protocol of assessing whether or not you're managing CRE lending very well. Is have you paired the objective data assessing supply and demand wherever you're lending. Certainly, expanding your loan review, we think, is very, very important now. This is not the time to frankly save fees on loan review. They need to be seen certainly as your, one of your front lines of defense. But these last 2 points are critically damning sometimes when we see orders come out, because in some we've seen where comments have been made, well, your credit shop or even your C-suite seems to be sensitive to some of these issues, but we're just not sensing that you're moving it up to the board level in explaining to the board and having the board in effect own the strategy that you have now with the CRE exposures. And a lot of it is even now morphing into things such as once you do a stress test, you've gone through the theoretical piece of that, but now what would be a theoretical impact on your strategic and capital plans? And we've literally seen that being cited as a weakness if somehow your board has not been using that as a dimension of their capital and strategic plans. But again, I think one of the things we have to accept in today's environment is simply this: if it is not included in your board minutes, it didn't happen, and it just, unfortunately, that's being used quite significantly. My segment, I'd like to close again by just highlighting the 3 primary pillars of IntelliCredit, which we think are so important in terms of post-booking credit risk management, which are portfolio analytics, loan review, and stress testing. I'll just briefly talk again about portfolio analytics. And if you basically pair the community banks to the mega banks, the community banks have still got some ground to catch up on in terms of really understanding the incredible value of the loan data that they sit on. It's your DNA, as I've said many times before. But I think one of the reasons that that's so important is under more scrutiny from regulators, you're going to have to use the portfolio data to either offset a negative perspective or perception by a regulator, and that has to be done pretty much in a quantitative manner using your data. For example, we have had a Midwestern bank executive say the regulator came in and very, very aggressively said, you've got a major concentration. This particular case was more agriculture, but he used his portfolio data It happened to be our tool, which was reassuring, but to basically disabuse the regulator from significant concern. He said, look at the data. We've got one loan 15 days past due in our ag portfolio. That's a microcosm of what I think you're going to be faced with this more intense scrutiny by the regulators. Loan review, you've heard me say this before many times. It's got to be seen as your ally in this environment. You want to not treat it as a hostile examination. You want that to be done in such a way that is informative of the bank's credit team and the board prior to a regulatory examination. And the caveat I always throw out there is please make sure you're asking for bios of people that are doing your loan review, because you'd want them to be kind of in that been there, done that mode to be able to be a good consultant for you, because that's really what loan review is. It's basically a consultative service. It's not an audit even by American accounting standards. And then finally, on stress testing, we've spent a tremendous amount of energy at IntelliCredit in the last year on refining our loan level and building our loan level stress test, frankly, to complement the robust portfolio level stress test capabilities that exist over at our sister division, QwickAnalytics. We even have two methodologies we use now. We use one that's more probability default, loss given default, that type of traditional approach, but one that can be done just concurrent to loan review, where we use proxies of debt service coverage, loan to values, and risk grade to basically extrapolate into the designated risk-based capital accounts associated with those subsets of the loans that you're making. But and we just recently published an article in the Independent Banker. Feel free, as Sean said, you'll get the deck after the presentation, and you can certainly read that in terms of what we would suggest to be good hygiene or good best practice around making use of your stress testing. So at this point, I'm going to stop sharing, and again, we're just absolutely delighted to share this quarterly webinar with Dan today. And Dan, it's all yours.
Awesome. Yeah, thanks, guys. It's really a privilege to be doing this, and we'll probably mix it up. I would expect Tim Keith, our founder and CEO, will do these as at least as often as I will. But that's great. So just as a frame of reference, the infusion perspective is very complementary to what's been shared. So it's a broad and deep perspective. We work with clients in 27 states, hundreds of banks and credit unions, $19 billion of balances we have generated through targeted, tracked marketing activities. So with clients, and then billions of reference points. So really a robust and practical perspective. And so that perspective is really contained in two sets of data assets that we have. We have very frequently we hear the infusion norm described, and often that is referring to the behavioral data that we've collected and continue to collect every day by working with and analyzing consumer and business behavior, customer behavior, member behavior if you're a credit union, and how they're interacting with product and services at banks. And so when we think about the needs that we're satisfying as banks and how those relate to balance sheet funding, securities, yield, and income driving things like transactors and fee income, that's all in that insight. We also, another part of the norm databases is the campaign tracking norm. So clients will work with us to get the perspective on growth opportunities through what's called our opportunity assessment analysis and consultation. But then when they work with us on specific campaigns, we work on a pay per performance basis. We obsessively track the results, and so that's where it's campaign behavior tracking how does it compare to peer norm on same types of campaigns? So those two perspectives really form the bedrock of our ability to provide an insight and analysis to clients to inform and to partner with them on specific tangible growth strategies. And so what I'm going to walk through is information from both of those data resources to help give you kind of a perspective on what we're seeing on customer behavior and campaign performance. One of the big trends, if we look back several quarters, is what's happening in checking. And so, unsurprisingly, as rates have risen, we're seeing the average balances held in household at the household level in checking. This is consumer checking that has ticked down, and so it's the average is down $2,000 year over year. What's interesting though is the product penetration on the right for interest checking has not risen as fast as the overall balance has come down. So as rates have risen, consumers are putting some of that lazy money to work that had accumulated in the pandemic. So 2020 comes around, rates go to zero. All of a sudden, didn't matter where you put, rates went to zero, cash is slopping around the system. Didn't matter where you put your money, you were going to make 0% on it. As rates have risen, they're doing that, and so we're not seeing that as much in checking. Still, really, really healthy. I mean, there's a floor to checking because people have to operate, whether or not it's consumers or businesses, they have to operate. But what we're really seeing is dramatic growth on the interest-bearing side, and so this is a blend of what we're seeing in community banks and some credit union activity, because it really illustrates we're in the same shape of this trend is happening across the board. So the average balance at the household level, or household, HH household, has risen by over 10% year over year. At the end of Q3, it peaked out at 101. And then the penetration rate has risen even more dramatically. So Q3 of last year was 8.6% penetration, blended average. This year it's 10.3%. So much more interest in CDs. Money market, with rates rising, the average balance has actually declined a little bit. Now it's stabilized on the household level, but penetration rate has increasing. And so when you think about what's happening in checking and in CDs, there has been an increasing interest on consumers' part for money markets because that gives us some yield and some flexibility, but not as much of a dramatic demand as the CD side. And so now, of course, that's going to change with the interest rates already dropping. We're already seeing some of that change happening, but this is the trailing effect. And so how that plays, one of the big drivers is certainly interactions by bankers every day, but we're seeing in the marketing campaign behavior, so driving demand in, whether or not it's customer cross-sell or acquisition campaigns. Well, these stats are more on the cross-sell side, but we're seeing as rates have, well, they rose, and then as they've started to come down a little bit, stabilize and come down, we've seen very elevated response rates from CDs. That's the chart on the left, that have started coming down. So the long-term average for CD campaign response rate, and this is booked response rate, so reach a specific audience, and then what's the actual booked account response. We're not looking at just clicks or anything like that, or leads. This is actually booked accounts. But you're seeing year over year, the blended average CD and share certificate response rate come down. Q3, it's very similar to what it was a year ago. But if you went back to Q1 of 2024, or even Q4 of 2023, it was as high as 5%. And then if you went back to Q1 of 2023, it was as high as 7%. So the response rate is coming down from a historically elevated place. On the right graph, you're seeing money market and high yield savings response rates. Those have been more steady. There was a little bit of a bump a few quarters ago. You can see in the middle, but so you can see money market response rates are much more steady, and we expect with the falling rate environment, those response rates may moderate some, just as consumers see the falling rates and they have an interest in kind of a resumed interest in CDs if they can get some term. But there's always a fundamental interest by consumers in money market because it gives them that mix of flexibility as well as some earning potential. So that's on the deposit side. Thinking about what's happening in some of the consumer lending buckets, we're seeing on this chart, and we're seeing what's happening in home equity. So home equity average balances are rising, and then on the right hand side, the penetrations are actually fairly steady. So certainly, what happened in this last quarter as rates started ticking down, some interest in lending sort of resumed. And then the next one is we're looking at unsecured loans, and here it's really interesting the difference between consumer credit unions and banks. Credit unions tend to historically been very, very aggressive on the unsecured loan or consumer loan side, and so you can see that household penetration rates on credit cards have been fairly steady for the last several quarters, but did tick down in Q3 just as rates started dropping. People started resuming interest in refinancing that kind of stuff. Bank side, on the flip side, it's been fairly steady. So we've seen a penetration rate on the household penetration of household, very, very similar over this cycle. And then credit cards are a little different. So as rates rose, the penetration of credit cards at credit unions in particular has been ticking down. So as rates have been elevated, credit cards have been relatively less attractive vehicles for credit as people have been more sensitive to some of those high interest rates. And so you've seen some lower penetration on the credit union side, but then the average credit card bank penetration has tended to be lower. This is the community bank peer set, and so it's been more consistent around a 3% average penetration. And so the campaign effect here is been actually very steady. So credit unions tend to perform much better on consumer loan campaigns, and so we've seen response rates in the 1.8 to 2.2 over the last few quarters. It has been ticking down as rates have been elevated. We expect that rates, though, as they start to drop, we may see response rates pick back up on all sorts of loan campaigns. But that's and then banks have been very steady on the consumer loan, much more home equity driven campaign activity from a loan perspective. So I think Sean, this is back to you.
Thank you, Dan. I appreciate that. Let me grab back the screen here.
Yeah, and so just as Sean is doing that, I may need to stop sharing.
Oh yeah, I think I can get it. I think Dan. So.
Yeah. So I just emphasize that it's really a joy to work with community banks all over the country to help understand kind of granular growth opportunities that fit your balance sheet objectives, and then actually make a difference in a tangible way. As you can see, some of the tracking activity on how we're able to specifically target and track back to those goals.
Awesome. Thank you very much for joining us today, Dan. We covered a lot today, and I think as Dan was pointing out, I mean, there's a lot for us to begin to share with what Infusion and Dan and the team can do for you. So we certainly encourage you to attend a future webinar where we can, better explain, all the different resources available through Infusion and how they can assist you as well. Just some final thoughts. Again, we did cover a lot, and going forward, we'll continue this format, but certainly remain optimistic about margins and earnings as we head into 25. As David touched on, we'll need to remain vigilant in managing our credits, and we'll continue to need to fight for deposits. So all the things that we know and love, but just a good reminder as we move forward. Again, just here at QwickRate and IntelliCredit, QwickAnalytics and Infusion, right? A lot going on. I think you'll start to see even additional. David touched on the stress testing. A lot of enhancements in the works. So we'll be looking forward to sharing those with you over the next 12 months. As David mentioned, they've been incredibly busy at IntelliCredit. Their client base continues to grow. Not only with loan review, but with now stress testing and the portfolio analyzer. So if you haven't attended one of the IntelliCredit webinars or are interested in learning more, certainly reach out to us, and David can get back to you and talk to you about the different services available. And on this slide, you can kind of see, we can help with third-party loan reviews. So we're always willing to discuss what you're doing today. Offer if you're interested in RFP. On the application side, the analyzer really does give you some detailed analysis that you can use for both annual reviews, even for potentially for loan reviews if you do things internally, but also a wealth of an incredible ability to create and generate your own reports kind of at the click of a few tabs. So certainly interested in it. I think one of the things we're really proud of is how quickly we can get you up and going. We are currently offering a 3-month trial on the analyzer. So certainly welcome you and suggest you take us up on our opportunity to do that. We'll work with you throughout the 3 months to make sure we get your data into a format you can use, but B, also work with you to make sure you can get everything out of it that you need. To that end, we will have a loan data coffee talk tomorrow. David Littleton and myself will be hosting that at 10 Eastern, so certainly encourage you to join for that. Steve Huntington and myself will be together on December 5th to do a coffee talk just on QwickAnalytics, just some of the other tools beyond CECL Solver that might be of interest to you. And then certainly Steve and I'll then come back on the 6th for our monthly CECL coffee talk. So a busy calendar. Certainly encourage you to join. As you again, if you register, you'll always get a copy of the slides and a link to the recording. So certainly welcome and encourage you to join us. Just a reminder that all of our past webinars and presentations are available on the YouTube channel. And then, finally, just want to thank you again for taking time out of your busy day. I know it's busy time of the year for joining us. Dan or David, any final words before we let everybody go today?
No, certainly hope everyone has great Thanksgiving coming up, and I know it's the real world in the banking world now, and that is a lot of things go on over a few weeks in the fourth quarter, right? Because we got holidays ahead, but we'll hopefully all good.
Good.
All right.
All right.
Happy Thanksgiving, and great to engage with you. And if you need help at the end as you hit the end of the year, we'd love to help.
Awesome. Dan, David, thank you again. Thanks to all of you for joining us. As mentioned, happy Thanksgiving. If you want to reach out to us, give us a call or info@quickrate.com, and we'll get you in touch with whatever area of we can help with. So thanks again for your time today, and we'll look forward to seeing you on a future webinar. Bye now.